All right, kind of goes to what we just talked about. For years, the sort of prevailing wisdom was private companies, they grow and then they get public as soon as possible. But some new data shows that that strategy of going public quickly to IPO, whatever, is going by the wayside. Let's find out why. Here now, CNBC Wealth editor Robert Frank, who writes about this in Inside Wealth. Robert.
Brian, great to see you. So if you look at IPOs so far this year, the good news is there's been a lot of them, but their median age is now 13 years old. That's up from 9 years old back in 2019. And if you go back to the 1980s, they were averaging or median 6 years old. So a big change over that period. There are now more than 1,200 unicorns. So that's private companies worth more than $1 billion. And they're staying private longer, so they're maturing longer. The revenue of companies that are going public has nearly doubled over the past 2 decades, from $110 million back in 2005 to $218 million last year. That's all inflation adjusted. Now, the big question, Brian, is whether those older companies means that there's lower returns for investors by the time they go public. You hear private equity venture capital firms saying the early years for startups generate the highest returns. But I spoke to Professor Jay Ritter at the University of Florida. He told me that the larger firms that go public actually fare better over the long run. If you look, Brian, at the big IPOs this year, whether it's CoreWeave, Circle, Figma, Klarna, they've all done pretty well since going public. So it's true that companies are staying private for longer, but it doesn't appear to be as true that they're therefore worse investments by the time they go public.
Well, to your point, there's so much money in the private markets, right?
Yeah, I mean, whether you look at institutional money from sovereign wealth funds to private equity, private credit, family offices, they don't need to go public anymore for that private capital. And even if they just want liquidity without going public, you've got Forge Global Equities in that can give individual shareholders equity to sell their shares if they want. So they've got liquidity for employees and they've got capital for the company to grow. So if you don't have to deal with all that compliance and the short-termism of shareholders, why would you go public?